So what we're going to be covering today are things that will help you save money, pay off your mortgage quicker, and really any other tips and trades to make sure that you don't end up paying more to the bank than you need to.
That's a good segue.
Hello, everyone, and welcome to Bamboo, Vancouver's property management podcast. My name is Hayes, and I'm here with Chris from Vine Group. What we're going to be discussing today is Mortgage 202. Now, we're assuming that since we are more geared towards an investor's side of things, that you probably have at least one mortgage, probably two. Yeah. So what we're going to be covering today are things that will help you save money, pay off your mortgage quicker, and really any other tips and trades to make sure that you don't end up paying more to the bank than you need to.
That's a good segue. Hey, awesome to be here. Thanks for having me, Hayes.
Wicked, thank you.
Yeah. So overall, just to give a little background, I've been a broker for 20 years. I've been at a few different brokerages now and recently moved over to Vine Group. The main catalyst for that change is because I've seen too many Canadians, going into or aging. I've been doing this for 20 years. I've started at 25. I'm 45. A lot of my clients that were my age now are getting closer to retirement. And I've seen too many of them, despite, getting good rates and having the benefit of low rates over 15 years pre-COVID and during COVID, they're still not getting far enough ahead, right? They're not saving enough for retirement and they're getting closer to retirement age, and they certainly do have a mortgage balance remaining. So, that's one of my bigger fears is going into retirement or overextending myself and having too much, and having an uncomfortable retirement overall because I'm going into it with debt or not enough invested.
Yeah, absolutely. In fact, I thought I just saw an article that a lot of boomers now are going into retirement with a mortgage now, which before that was like a rite of passage that you burn the papers, you know what I mean? And
you think about it, like this is why the advice that worked for our parents and our grandparents is outdated because they got into the housing market in their 20s usually, right? They could pay it off on one income over a 25, 30-year period.
Yeah, put you on 45, 55.
Right.
Yeah, I guess.
Cost of living was so low compared to now, even the price of houses back then was so low.
Yeah.
Right? You can't afford to buy it with one income. You can't do that now.
Nope,
right? It's usually a double income family.
Yeah.
And now you've got the expense of daycare. You've got the rising cost of inflation, the rising cost of living. Housing is 8 to 10 times our income now. So you've got, housing affordability is more out of reach. So mortgages are extended for longer and longer, 25, 30. There's even 35 year available now too in the B lender space. So all of that was kind of like the aha moment. There has to be a better way to pay off your mortgage, right? And most people focus on what's your rate, right?
Yeah,
and
everyone asks that.
Of course, everybody asks that. Right?
What's your rate?
Well, it's because we've been trained to understand, that that's the value is what's your rate.
Yeah.
But interest rate alone will maybe save you a couple bucks a month, and overall over a term, a few $100. So that doesn't meaningfully get you closer to retirement or save you enough money so you can invest.
Yeah,
right?
Absolutely.
So all of these strategies that, like the reason I moved over to Vine Group is we not only encourage it, we support it, right? Through advanced and ongoing coaching as well.
Okay.
Right. So like real life case studies, always saying like we have a client who fill in the blank and here's our situation that we're dealing with, and the mechanics of how you structure that person's mortgage can be a little bit unique or need to be a little bit more creative. But overall, it's designing your financial freedom around your investments and using your house like the tool it's always been designed to be.
Yeah. Okay. Well, that's definitely some good background and we should get into this.
Okay. Wonderful. Yeah. That's a lot.
Yeah, that's all right. So now, and those who are like following along here, some of the stuff we're going to get into will be, I guess, can be a little bit heavier. So you may want to make sure that you, if you need to go back, just hit back 15 seconds and write a note. Because as I said, this is 202. Most people are covering, how to get a mortgage and that sort of thing. But we're making the assumption that you already have one or at least know that bit of it. So just so you know, as I said, this one is going to be a little bit more technical.
Is it beyond the basics, but really the fundamentals are still there.
Yeah,
right. It's
absolutely.
just you have to structure your mortgage in certain ways in order to take best advantage of these strategies.
Yeah, absolutely. Right. And we'll have your contact in the description. So if you really need some more information, you can call Chris and get all the information. So yeah, I guess one of the ones that I had originally called you about was called the Smith maneuver.
Right.
I don't know why that's called the Smith maneuver. Maybe you do. So, and maybe if you can just explain to our listeners what exactly that is, since I gather that was the basis one, and then there's a couple other things you can do as well. Yeah. So
it is the foundation for anything that we're going to discuss as far as advanced strategies or appendages of or extensions of. The Smith maneuver is the Smith maneuver because it just sounds like a name, right? Because it is. It's Fraser Smith came up with it back in the 80s, and he was looking for ways as to how we can have our mortgage, the interest we pay on our mortgages, tax deductible. Well, they are, but only for a subset of mortgages right now on rental properties. Right. So it's available. You can deduct your interest off of your mortgage if the mortgage is tied to a rental property because it's an investment.
Right? So for this to work, you need your mortgage to be tied to a rental property is essentially step one.
No. We're getting a little ahead of ourselves there. He just realized there's a difference between our neighbors down south and us. Because in the U.S. you can. It doesn't matter whether it's a rental or a owner occupied. That mortgage interest is deductible against your income every year.
That would be nice.
So in his efforts to say, why isn't that the case here? We have a different tax code, different tax laws, different country. It's a different rule. We just didn't, that's not deductible for us.
Yeah.
So in an effort to find a way to legally convert our interest on our primary home's mortgage into a tax-deductible investment loan, the Fraser Smith came up with the Smith maneuver.
Okay, excellent. So this Fraser Smith is the inventor of what we're about to talk about.
Smith maneuver. He's since passed on. His son Robinson is the one who's taking the reins now. And if you are a Smith maneuver certified professional like I am, then you also receive ongoing coaching weekly with Robinson directly.
Oh, nice.
Yeah,
that's very helpful.
So through the extensions of Fraser, the legacy continues, and it still continues 40 years later, but it's a fully CRA vetted strategy that's been around since the 80s.
Okay, and that's a perfect segue for us to also remind everybody that do make sure that you speak with your tax professionals.
Yes.
This is not the end-all be-all financial advice. This is just sort of guiding you towards the right place, but do make sure that you check because you could get yourself in a lot of trouble if you half knowledge something. And
that's part of what we do as well. Is we make sure that we also have vetted professionals that we can recommend as part of our overall strategy.
Perfect.
Right.
Yeah. So just want to make sure we're covered now.
Yeah, we're definitely aligned on that here. It's an important piece because we're as a mortgage broker, as a realtor, you can't give financial advice of where you can invest that money. Yeah. But a financial planner can.
Yeah.
Say any more than I can give tax advice of what you should and shouldn't do with your tax setup.
Yeah, absolutely.
Right?
Yeah. So let's start off with what the Smith maneuver. How do we begin?
Okay. Cole's notes, Smith maneuver basically is a way for you to invest while you're paying down your mortgage at the same time.
Okay.
Because the Canadian dream, borrowing from the American dream, is white picket fence. You got the house and you're paid for, and now you're fully invested, and you're able to retire comfortably at 65.
Yeah,
right?
Absolutely,
or sooner, right? Hopefully. Well, that Canadian dream is more becoming the Canadian nightmare.
Yeah.
For a lot of people, because if you're going into retirement with that debt, how do you get rid of it, right?
Yeah.
When you consider the rise in the cost of living, the housing costs, the need for higher and bigger mortgages, that mortgage payments alone are considerably outpacing our growth in income. There has to be a better way, and people don't have the money to be able to invest. So how do you avoid the Canadian nightmare of paying a mortgage that you just start in your mid-30s because you're entering in later in life than our parents did? You're 10 years, if you're lucky, later as a starting point to being a homeowner, but you're starting with a higher mortgage amount on a higher home value, significantly higher, right?
Yeah.
So yes, you might prescribe yourself to a 30-year, and if you started at 35, 30 years later, you're 65. Okay, now you followed all the rules, you followed all the advice. I'm mortgage free now. Now I have to invest when?
Yeah.
When you're 65, when you're ready to retire?
Yeah, that's not,
right?
not a smooth one.
Exactly.
Yeah.
So the Smith maneuver solves that problem without actually increasing your capital investment. Okay. So it takes your existing mortgage payment that you're already making in the right structured mortgage with a readvanceable line of credit.
Okay.
Okay. So your structure has to be set up properly. There's mechanisms within that we'll make sure we have for you and your clients. But when you pay your mortgage, there's a portion of it that goes towards principal.
Yes.
Right. So every mortgage payment you're already making has an interest component and a principal component.
Of course.
Okay. The principal amount that it gets paid down by in a properly structured mortgage, it will be available dollar for dollar the next day on your home equity line of credit.
Yeah.
You use the principal pay down from every mortgage payment you're already making and then reinvest the principal pay down direct to your planner.
Okay.
Okay. And in the right type of investment too. So this is, again, a good reminder. We recommend certain financial planners or ones to help you with that part of the planning because there's only certain qualified types of investments.
Okay.
You couldn't invest in an RSP, for example, with that money and get the tax write-off because the RSP already has its own tax protections.
Yeah, of course.
Okay, that's a registered plan, so you want to avoid ones like those.
Okay. So definitely avoid the RSPs. And again, the financial planners will tell you where to put this to make this actually go so you don't shoot yourself. So don't buy Bitcoin is what you're saying.
Correct.
Okay.
It's not qualifying.
Really?
Yeah, it's not qualifying. But it could be if it's in an ETF, like with Wealthsimple, for example.
Yeah.
Right?
Still don't think I'd be buying it.
Yeah.
Crypto.
Either way, hey, just saying, I'm sure there's some crypto people here.
Yeah, I don't have like white sunglasses. I can't do it.
Yeah. Hey, you can be into crypto and not be a crypto bro.
Can you though?
I don't know.
So once we got that, I'm assuming that we obviously need to have a HELOC or home equity line of credit.
Yeah.
So after that, what happens? How does this work? Like just using an arbitrary numbers.
Yeah. I've got an example. Like if you were if you had like a $540,000 mortgage, right, and you just made your regular mortgage payments, the principal amount that you pay down every month or every couple of weeks, you reinvest on the fly. Like exactly when that happens, you invest with your planner. They invest in a income producing asset, and that generates you a return, and you're now earning compound interest while you're trying to pay down the compound interest faster on your mortgage at the same time. So every year, you're going to have now everything you've invested with using your HELOC is now the interest you pay on that is tax deductible.
Yeah.
So it's those tax refunds you're creating, those tax deductions you create that didn't exist before that generate tax refunds every year.
Okay.
You use those tax refunds to apply that as a lump sum
to your
principal balance on your primary mortgage. And then those same dollars for dollar, are available now in your line of credit the next day, and you invest that as well.
Yeah, and so you just kind of keep the cycle
rinse and repeat.
I got
do it every month, do it every couple of weeks, whatever your pace is for your mortgage payments, do it every single time you make that payment.
Yeah.
You redirect the principal into a clearing account, and you send it off to your planner. Like an auto debit from them, and you just have an agreement between you and your planner.
Yeah. That way they do their thing and you stay the hell out of the way.
Yeah. What ends up happening over time is you're slowly converting the non-deductible interest that you were paying on your primary mortgage into a tax-deductible investment loan.
Yeah.
Right. And your net wealth, like in that example I've got think about it here, $540,000, right? If you do nothing different, it takes 30 years to pay off the mortgage, right? But if you implement the Smith maneuver right out of the gate, reinvest monthly and use their tax refunds to pay down the mortgage, you're debt-free in 20.8 years instead of 30.
A pretty significant savings on interest, hey?
It's considerable, right? And investments grow at to $820,000. That's assuming an 8% return every year, right? Like that's your average over that same time period.
Yeah. Now, with some of the clients that you've had, have they seen that 8%? Or is that just,
myself as well. You've got to be nimble, and you've got to be working with the right planner and somebody who's on top of that, and they've got the right team. They've got a quant guy. They've got somebody who's managing that. Right on the go, because the market does change.
Of course,
right? It's going to change and it can flip overnight. But if you're proactive and you're managing it, you have somebody managing it, not just here's money RBC and dump it into a mutual fund and hope and pray. have a planner, right? Just like you wouldn't navigate negotiating real estate without your help, right?
Yeah, absolutely. Like anybody can do it on their own, but there's a quote that says just because you can throw a punch doesn't mean you can box. So that's true. That's true. Say that way because I've seen lots of people. I looked it up on YouTube. I can do this. I'm like, okay, but I mean, you've been doing this for 20 some odd years. Chances are you probably have a better idea than some guy from YouTube.
Exactly.
That doesn't know.
And it involves too, because I have been for 19 years, basically been in the same boat, trying to fight and argue for the best rate and, negotiate the best terms, make sure I educate and highlight those areas you want to be aware of, like when you're getting a mortgage, doing my job and I do and making a good living doing it. But I, find that the advanced strategies are really, like, you think about my own personal timeline, started at 25, 20 years later, I'm the age that, a lot of my clients were when I first started, right? So they're approaching retirement. And if they've got mortgage debt and they don't have enough invested, it's like, what if they don't have a pension? Because unless you work for the government, unless you were a teacher, like pensions used to be the norm. Yeah. Right? Like, so like grandparents' advice. Well, most financial advice you're getting from your parents too. It's your grandparents down to your parents, and your parents just pass the same wisdom down to you. Yeah. But it applied for your grandpa. Yeah. It applied for grandma. It applied for your parents. It worked, right? There's pensions you can rely on in retirement. Yeah. You don't have to have as much invested if you're getting a steady paycheck like that to add on top of your CPP and OAS. Yeah. But you don't, right? So the Smith maneuver solves all of that by not delaying the timeline when you first invest and just going against the wisdom, if you will, that's been passed down to us from generations that works better for the bank than it does for your bank account. Yeah, fair enough, right? Now, that being said, with the Smith maneuver, some people already have their mortgage. It's never too late to start, I'm assuming. No, not at all. You can, if you're already gone through your first 2 terms of your mortgage, you can start and stop. You can start and stop at any time. Like, it works better for a longer timeline. Like, if you're trying to link it up with your original amortization and you're doing it right on the fly, then this example, like real life example, I don't share names, but $540,000 mortgage, right, paid off 10 years faster just by using those tax refunds that are generated every year. Yeah. But what if you started off later in your, not just your mortgage journey, but maybe your life journey? Yeah. Right. But you build a bunch of equity and you want to make sure that you're building your nest egg at the same time or having to play a little catch up. You can do a prime the pump. That's one of the accelerators that helps accelerate the time and the results for the Smith maneuver. You take a prescribed amount from your equity and you prime the pump by providing a lump sum to your planner that you're building and compounding off of a higher starting amount versus starting at 0 and contributing $500 every month, for example. It takes longer to build that up to $1 million. Yeah, right. Of course. And if you started with 150, 120, 200 down. Right. Yeah, then you're building quicker. You're building on top of a higher base, right? And you're compounding something much bigger. And compounding works when it's bigger or it's longer or both. Yeah, and now I assume that like most mortgages have a maximum bubble payment that you can do per year, that sort of thing. So you kind of like work within those realms. So you don't end up with a penalty, I guess, right? Yes, you can work within those, but also there's certain features and structures of how your mortgage and even how that HELOC is in relation to your mortgage that is not only important to have a feature, but it's something that we guide you and make sure it is structured as part of your overall plan, right? Absolutely. But there are lenders, yes, most every single one of them, 99% of them, would have a limit on what you can prepay, right? When it comes to the line, no limit. Yeah. Right. So there's other unique strategies that are also just a mortgage product that if you were to redirect your income in a different, more efficient way, you don't really have a limit on your lump sum. It's all your income is working towards paying down your mortgage debt every day. Nice. Right. Yeah. So it's definitely things to look into as far as that there seems to be quite a lot of intricacies, which obviously we can't cover in one podcast. No. There's tons. But that's the basic concept is instead of like following the grandma and grandpa and we just advice, pay monthly and take it. Well, it was pay your mortgage off first. Get rid of debt because all debt is bad. Yeah. Right? All debt is bad. If you got that money mindset, all debt is bad. You're going to focus all of your efforts to pay off your debt. That's great for consumer debt, but it's not necessarily great when it comes to your mortgage debt. Yeah. Okay. Consumer debt is usually frivolous, something like sometimes you're stuck with a a longer timeline to pay off your credit card bill because you were silly with your money when you're a teenager.
Yeah, right? I have a lot of clients here. They're just getting into purchasing now because they finally have paid off those 3 credit cards that they maxed when they were in Guatemala or whatever. It's like, dude, come on, man.
Well, you know what? It just like home ownership, advanced strategies within the mortgage side of things requires more discipline, just in how you manage your day-to-day, how you manage your month-to-month, and just that you're managing at all, right? Instead of just impulse buying along the way and kind of living the way we lived when we were younger, right? Yeah. So that kind of approach doesn't work if you're trying to advance your plan when it comes to mortgages in general. It's a very simple concept of how it works is every principal portion of your mortgage payment that pays down your mortgage gets available on the line of credit, and you use those funds to direct over to your planner. Yeah. That is not waiting those 25 to 30 years to pay off your mortgage, and then now you don't have the mortgage payment, and you invest the savings direct to your planner. Even though that might be a higher number, it's also 25 to 30 years in the future. You've lost on them like decades worth of compounding interest working for you.
Yeah, absolutely. Right? Now, with that, it sounds fine and all. And of course, everybody wants to make sure that they're paid down. So with that being paid down and all that, there must be some cons to this. Otherwise, everybody would do this, no?
Well,
what are the risks, I guess, that are involved?
Really, we've done a lot of the coaching and ongoing efforts on our side within our own community at Vine to make sure that you don't go it alone, right? Going alone, the DIY, that's the biggest risk. Yeah, is the DIY, right? Because you think you're doing it right, but if you ever commingle business expenses, which would be like anything that's tied to an investment, whether that's a rental property or your portfolio that you're building over time with the Smith maneuver, anything like that is deductible. But if you commingle your business expenses, if you will, with personal consumption expenses, you just blew up the plan. Yeah, so it's kind of you didn't know you did it, right? You can try and track the interest separately, but there's better products if you wanted to do that, right? There's better products if you wanted the safety net of a personal line of credit built into your overall equity that you have. There's a better plan, right? Or a better structure at least that you can do that. But commingling personal and business expenses is the number one.
The way that, and people end up shooting themselves in the foot.
Shooting yourself in the foot, number one way. But also not working with the right professionals, right? If you've always had your dad's accountant, right, and you always worked with them, that's great if you're a T4 and you're just, filing a return, right? But if you need something more advanced, more complicated, your mortgage structure and how they generate statements and track interest expenses is hugely important on how convenient that can be and how easy and safeguarded your whole tax filing can be. Okay. Right. But working with the right professionals, like my accountant does the Smith maneuver herself, right? Which is probably a good thing to have. Somebody's actually walking the walk. Exactly. Same thing. From our history too, that, my partner and I, we have a couple of different rental properties as well. Absolutely. Right? So we're exercising the same thing within the Smith maneuver. You can do another accelerator and treat your rental property like the actual investment it is, and funnel your cash flow in a more tax efficient way within the Smith maneuver framework as well. Yeah, now that one is requiring to have a rental property. It's called cash damming, correct? Correct. Yeah. So this is cash damming. This is another, as you said, part of the Smith maneuver framework, but not exactly the same thing. Yeah. And that. So how would that work? For this one, it's assumed that you have to have a rental property, and you were saying before we went on air today that you can actually use your basement suite as well. So it can be in your actual home as well, since a lot of us have a basement suite for rent. That's right. So can you maybe touch in on how cash damming would work to, again, pay off the mortgage quicker and probably get us closer to keeping the rents covering one another, because right now being cash flow positive in Vancouver is basically impossible for the first 7 years of your mortgage if you just go at it the normal way, unless you manage to somehow steal one. We'll talk to you about that right now. Right?
Right now is a great time for people to buy.
Exactly. But with respect to cash damming, it solves a pain point or a lens that people look at rentals through is it immediately cash flow positive. Yeah. Well, it's not, because of the rising cost of housing and the higher mortgage amounts you need and the higher interest rate environment we're in right now. It's even harder.
Currently, the rents are going down as well.
Exactly.
So exactly. A lot of things is making this gap wider for the mom and pop's investor.
And if you're looking at it like holistically, I'm looking at here's what's coming in, here's what's going out, and here's the gap, right? Then you might shy away from buying the rental property at all. Yeah, but like you've already said, for the first 5 to 7 years, if you set up your mortgage properly, it can be faster. But in the first mortgage term or a bit, you're probably not going to be breaking even.
No,
right? You're going to be underwater, right?
Yeah.
But within the Smith maneuver framework, cash damming is, in this case, we'll have the rental property being the investment that we're going to be running the Smith maneuver framework through.
Okay, so you're saying as in, instead of sending it to your financial advisor who would invest it in whatever they invested in EFTs or whatnot like this, basically the EFT or the investment would be the rental property is what you're saying. Okay.
Yeah.
So, just clarifying so that people can follow.
Well, what you would do is the rental income normally, conceptually, it would be easier to understand if you're looking at a condo and you live in a house and you have the condo as a rental, right?
Okay, so let's use that for our example.
Okay, so most people, the way we've been taught is that all the rental income comes in and I'm going to pay the rental expenses direct.
Yeah.
Right? And if there's a shortfall, I cover all of it.
Yeah, so the rental expenses being the mortgage in particular.
Exactly. Well, it's the mortgage, it's the strata fees, it's the property taxes as well, right? If you got a property manager, he's an excellent property manager too, by the way. Okay. So those are the expenses that are deductible just on their own, right? But the principal payment typically isn't. Right? It's the interest that you're paying, right? But everything else, you would, instead of you taking the rental income from the condo and paying the condo's expenses, mortgage payment, strata fees, property taxes, all of it, direct, and any shortfall you cover on your own, because you already have the Smith maneuver set up on your primary, the mortgage and the readvanceable line of credit.
Yes.
Okay. You would take the rental income and dump it on the primary.
Yeah, onto your principal.
On the principal portion, the mortgage portion of your mortgage. Dollar for dollar, that $3,000 pays down your mortgage by $3,000.
Yeah.
Now that builds the room in the line of credit, just like it does in the Smith maneuver, right? But instead of you investing with your planner, you expense the rental property expenses from the same line of credit.
Okay.
Okay. You'd want to carve these out and separate them within the line of credit, so it's easy to track. Here's the investor stuff. Here's the property stuff, right?
Yeah.
But when you do it that way, now you are creating tax deductions again that didn't exist, and tax refunds are amplified. What you're already getting in return for running the Smith maneuver with your planner, you can accelerate how quickly you can generate your refunds and returns and the amount of them, and how much faster you can pay off your mortgage if you were also to cash them. You can do it on its own. You don't have to Smith maneuver at the same time, but it's the same thing, except for instead of the money redirected from the line of credit to your planner to invest with, you redirect that to expense mortgage payments, strata fees, property taxes on the rental property.
Yeah.
And if there is a shortfall within that framework, because you have every tax return and rental payment that you receive, you're dumping on your mortgage, you're creating more and more room in the line.
Yeah.
So now the line can cover some of that shortfall in actual terms. In real terms, if you're $1,000 short, I have a client who's exactly in this boat right now.
Yeah.
And he only has to contribute $400, but his actual gap is about $1,400.
Okay.
Okay. So, and that keeps his amortization the same at 30 years, but it keeps his tax refunds coming, and it keeps his overall portfolio, because he's going to have one primary home and 2 rentals.
Yeah.
He's going to have 3 properties appreciating over the same amortization of one properties.
Yeah.
Right.
Once you hit that, you're out.
Yeah. Well, and then you got options, right? Yeah. Then what if you sell one of those rental properties? Great. Net of any capital gains, you're paying off a bunch of the other debt.
Yeah.
Right.
Absolutely.
And or contributing a big lump sum towards your financial plan. Right.
Yeah. I mean, absolutely makes sense. So basically, you taking the rent, dumping it onto your own.
On the primary part.
On the primary part. That raises, or it takes down your principal, and you can write off the interest on that, which gives you a higher tax return. And then with that cash, I guess put that on your principal? Or?
You do.
Yeah.
Exactly. Just like you would if you're investing on the fly with your Smith maneuver to your planner, you generate tax refunds from deducting the interest on that portion that you're investing with, right? You do the same thing on the rental cash admin portion.
Okay.
As the expense is on the investment property, so that is deductible. So, when you funnel it through there.
Yeah, and with the expense, you are talking about paying the mortgage.
Correct.
Just so people are following. So
Exactly.
that you don't just take the rental money and put it in your pocket. You have to make sure you pay that mortgage.
Well, of course, but that's the thing is what if you break down what you're getting as annual tax refunds, those can increase if you add in accelerators.
Yeah.
Right. Another one would be, what if you had already invested? What if you and I connected at this stage in life and you already had $200,000 invested in non-registered investments, so things outside of your RSPs, right? Keep them in there is one, and just get the dividends that you get paid every month, and dump that on your mortgage and reinvest back to the same dividend paying investment, and you just created a tax flow right there. Yeah. That'll be like a debt dividend reinvestment plan.
Sort of like doing like the S&P 500 or something, and just keep on the dividends and just keep on returning them.
Keep on funneling them back in.
Yeah.
Funnel them back in. But what you're really doing in the meantime, you're doing one extra move. You're paying down your mortgage with it first, and you create the room with the line of credit, then you send it back.
Okay.
Right?
So it's like one extra step. Yeah. So you get extra write-offs, basically.
Or if you've already have, like, say you have $200,000 invested in non-registered, right? And you're happy with the mortgage you have right now, you have the same mortgage debt, you have the same investment, you just cash that out to pay down your mortgage by the same amount, and then replenish the investments by drawing back up the line of credit, same mortgage balance, same invested. You just created those investments. So you created a tax deduction on those same investments you already had. Yeah,
which again was how we get further down. And as that tax break gets bigger and bigger and bigger,
correct,
then you pay
your mortgage timeline gets smaller and smaller and smaller. The volume of interest that you pay is considerably lower. That's why you can't achieve mortgage freedom any faster by trying to nickel and dime or day trade your mortgage rate.
Yeah,
you can't do that, right? Because ultimately, over a 3 to 5 year term, you're only saving a few $100.
Yeah,
right. If you get a little bit lower on your mortgage rate, it doesn't advance how quickly you can be mortgage free and how quickly you can retire. Right. What does is making sure that you implement, when you have at least 20% equity, you implement the one or more of these strategies, because frankly speaking, you're going to have to. If you want to be able to retire, if you don't want to be a Walmart grader when you're in your 80s, right? If you don't want to go into retirement with mortgage debt or not enough invested, unless you have a pension, unless you've won the lottery, unless you have been investing at a young age and you've been very disciplined with that investment. Yeah,
which most of us have not.
Most people haven't, right? And with rising cost of living, the rising cost of housing, housing costs outpacing, and just even you think about your income taxes alone, as those have grown, 43% of our income on average is going to the government. Yeah. Right. And that's outpaced what shelter costs and food and clothing is combined for most people. Yeah. It's just your taxes. So if you can flip the script and start getting money from the CRA, you don't like the plan of the numbers, the results we're sharing with our clients. That's assuming you follow it to the T. Yeah. Right. And you get but there's no rule that says if I get a tax refund from the CRA that I have to dump it on my mortgage. Yeah. There's any more than there's a rule that says any rental income that comes in, I have to redirect and apply it direct to the rental property. Yeah. There's no rule around that. So what if, you got a $5,000 tax refund from the CRA next year after implementing these strategies, and you use that to go on vacation? Yeah. Rather than put that on a credit card and pay 22% over however long it takes you to pay off that balance, you just did it for free. Yeah. The CRA just paid you to go to Hawaii. Yeah, no problem. Don't do it every year because you're not going to pay it off any faster. Don't do it every year, right? Obviously, but it's, what if you had a big vacation for your family every 5 years, right? Yeah. What if you haven't been able to afford one for 15 years, right? What a huge shift that can be for people.
Absolutely. Right? I suppose with the mental shift too, like, finally get to do something. Right.
Well, also huge, I think your quality of life shift, because, I think there's a lot of pressure on us daily to where we're worried. I think there's more people who are depressed and anxious, right? Just
Absolutely.
in general.
I've noticed that.
Right? Just in general,
Yeah.
right? Part of that, like most of the problem is money related,
Mm-hmm.
right? Most of that worry would be, I'm not going to be able to retire,
Yeah.
right? Or I'm going to be working like forever. I'm never going to get off this hamster wheel. I'm going to be paying interest forever. I'm never going to be able to have time to invest. And when I'm finally mortgage free, then I'm going to invest. It's like,
too little, too late.
I think there's a better way. Well, I know there's a better way, right?
Absolutely.
But there's a better future available to you if you were to look at your debt differently and understand the difference between good debt and bad debt.
Yeah, which is something that a lot of people do not realize.
Right.
That there is a difference between good and bad debt.
And the other thing is people think they're that we need a side hustle. Like inflation has already caused the TikTok side hustle, right? If you will.
Your feet pictures on OnlyFans.
They're pretty nice. They're pretty nice, I gotta say. But you have, more income won't solve the problem. You don't have to do anything more than make your regular mortgage payment.
Yeah. The other
Just
thing too,
redirecting the principal in a tax efficient way. This is what the wealthy have been doing for years. They've known this for years. Leverage, but we've been taught that leverage is such a bad word. It's dirty.
Yeah.
But nobody if you didn't rely on leverage to some degree, then you're buying every house with cash. Like, what do you think a mortgage is?
Yeah, exactly.
You're leveraging the bank's money that you don't have in order to close on this and pay that over a 25 or 30-year timeline.
For sure. I mean, and that's the other thing that you brought up about getting a higher income probably won't help. No. And it's funny because the higher your income, the more they tax you. So,
that's exactly right.
Cutting that leg out and getting the taxes down is the move.
Cutting your leg out. Yeah, you're trying to do like a potato sack run with one leg, right?
Yeah.
It's very difficult to do.
Yeah,
right?
Absolutely.
I don't know if that expression existed before, but
it does now, man.
Thoughts in my head now. That'd be very hard to do. But I've got some numbers here as well. These are all examples from our own clients.
Sure.
But I had another example where if we were to just the cash out and accelerator, right? So just the cash out and accelerator on top of doing the Smith maneuver. So like in layman's terms, you're investing on the fly instead of waiting until you're mortgage free.
Yes.
Right? That's the Smith maneuver part of it. You accelerate it with the cash out by redirecting your rental income in a more tax efficient way.
Yeah.
Okay.
So there are two things accelerating.
Boom. They're both accelerating. So Smith maneuver alone, the plain Jane version we talked about, that is going to help you be mortgage free 10 years faster. You accelerate it with the cash timing. Now your mortgage freedom is in 9 years. 9 years. 9 years, right? Just by redirecting your income that you're already, and your mortgage payments you're already making, the rental income and your employment income you're already earning, and the mortgage payment you're already making. Yeah, you just restructure in a more tax efficient way.
Yeah, and that absolutely makes sense to get that and just beat up your mortgage, basically.
That's it. That's it. Just because you could throw a punch, you can box. You can box in this one, right? And you're beating the crap out of your interest. And what you're overall doing is you're reducing the volume of interest by, especially when you consider how many years you're able to take away.
Oh yeah,
right?
Absolutely.
Well, think about if you're able to save 100 months, right?
That's 100 months. A lot of interest.
2,000 payments.
Yeah.
Right? How much interest are you saving? How many payments alone? Never mind the interest. What's your cash flow improvement?
Yeah, absolutely.
Right? Insane.
Yeah. It's a huge thing. I mean, and I guess on a much lower level, like we talked about bubble payments, for instance, and I forget what it was, like one a year or something like that would change things like by a couple of years.
Well, for sure. Even within the finer details of your mortgage, you can get more granular and a little bit more efficient, right?
Yeah.
Your mortgage payment, if you're paying monthly, you can have a rate, 25 basis points lower than mine. If I'm paying accelerated biweekly and I increase that payment, round it up like you do at the grocery store.
Yeah,
register. I'm going to round up for the kids.
Yeah.
I round it up, right? Now I paid a lower volume of interest than your fancy lower rate did.
Yeah,
right. So there's ways within the mortgage that you can pay it off faster, more conveniently, and more automatically. But even within that, the banks have two different type of biweekly payments.
Okay.
Right. Regular and accelerated.
Okay.
Right?
What is the difference between the two?
Okay, so over a 12-month period, you're paying 12 mortgage payments,
yes.
right? If you're doing monthly.
Mhm.
Regular biweekly takes that 12 months and divides equally over 26 payments.
Okay.
Okay. So like $1,000 payment, like divided over 26, it's like $460, I think it is, somewhere in that range, right? 461. But the accelerated is exactly half. It's $500 paid every 2 weeks.
Okay.
Right. But what it, like, that's the shorthand math is whatever your monthly payment is, cut it in half, and that will be your accelerated payment. Okay. If it's anything lower, then they're trying to get you into a regular payment that doesn't pay off your mortgage any faster than monthly.
Yes. So do be aware of that.
Well, it's by design, right?
Yeah.
Because the impression that we all have is bi-weekly. The frequency that we pay our mortgages is actually more effective, but it's the amount of the payment that matters.
Yes.
Right. And what accelerates your mortgage is by increasing your payment. And what you're effectively doing is over the same 12 months, you're paying 13 monthly payments.
Yeah. 13
divided into 26 is even.
Yeah.
26 divided by 13 is half.
Yep.
Right. That's why monthly divided in half, if it's $1,000 a month, your rapid or accelerated biweekly better be 500.
Yeah.
Right? Because if it's 461, you're being duped.
Okay. So make sure that it is exactly half of what you're over your.
Otherwise, you get to the finish line if you're not paying attention. If you don't have somebody like checking in with you, right? Then you're going to get to the end of the term and you're like, hey, I didn't pay it off any faster. This just is bi-weekly. I thought I was supposed to be mortgage free faster.
Yeah.
Nope.
You're not. Because of course the banks don't want you to pay it off. That's how they make their cash.
Exactly. They make their living and they make their billions of dollars by keeping you on the treadmill.
Yeah.
Right. What we're doing at Vine Group and with my team is we are focused like exclusively on the advanced strategies to help you pay off your mortgage, 10 to 20 years faster, retire 3 to 4 times wealthier.
That both sounds like a good idea.
Wow. Well, follow your grandparents' advice. You're going to get, you're going to get really, you're going to get stuck.
Yeah.
Right. You're going to get stuck being a grandpa working at Walmart.
Yeah.
Frankly.
Which is not what I'm interested in.
No. No.
Perfect. Well, I think we've covered a fair amount and we don't want to overload our guys' brains here. So
I feel like we have.
Probably. But
I might have.
But this way we can get a hold of you. So what is the best way to find you so that you can really get into the nitty gritty and send some images perhaps to help people keep on track?
We have calculators, right? We have a unique way to make sure that it's not only just us providing you advice, we're helping you improve your understanding and share our wisdom with you. Yes. And we do, it's more show versus tell. Right? So when we have our, everything that we need in order to develop a plan for you, then we bring you in on the plan and show you the mechanics at work and the results that you can expect.
Yeah, which is a good thing.
Right. And we favor conservative too. Like even when we're forecasting appreciation for home growth value over a 25 to 30 year period, we're not favoring what has been, which like the 2005 to 2020 range, the average Canada-wide, coast to coast, annual return was 6.1%.
Yeah.
In my calculator, I use 3.
Yeah. So you better to aim low and be pleasantly surprised.
Of course.
Perfect,
exactly.
Right?
We don't of course, I don't want to be lofty in that kind of expectation. Or I don't even want to include what was, right? Yeah. Like let's use that as our guidepost and then cut that in half.
Perfect.
Right? And say, here's your results if you only achieved a 3% average return on your home appreciation over the same timeline.
Excellent. So what is the best way to contact you? Do you your email, phone number, website? All of it will be in the description below. But
best way is actually to book a call, right? And it's you've got to talk to Chris, right? So www.talktochris.ca.
That's a pretty easy one.
That'll take you right to my booking link and take you right to my booking site. You just choose a time there, any of the times available, and you can we can have a chat.
Great. Sounds great. Thank you very much for coming on the show. We really appreciate it. And I know that I'm getting caught up, but I'll definitely have to review our show myself to make sure that I don't shoot myself in the foot.
Well, that's what you have before here. We wanted to touch on quite a few things as to what you can do when it comes to, how you can pay off your mortgage faster and not lose out, how you can invest and not lose that time. Yeah. Right. We've touched on a lot of different kind of things that we can do, but overall, it really starts with a conversation to see what you want to do.
Yeah, absolutely. Right? Great. Well, thank you very much if you've been listening this long. My name is Hayes. This has been Bamboo, Vancouver's Property Management Investment Podcast.